China is now dumping massive amounts of treasuries, and everyone's saying, or at least a few months ago, China's doing this as an act of war. BRICS currencies are going to take over, and China is going to rule the world. But what me and Justin are thinking is maybe this is an act of weakness, and China's not dumping treasuries in an act of strength, but they're selling them at a loss because they need dollar liquidity. And they're not dumping dollars, but they're trying to get dollars as fast as they can. Maybe because the rest of the world sees China as a huge risk, and they don't trust the Chinese counterpart as much as everyone else might think. Justin.
I think the idea of liquidity is a really important thing that it took me a long time to figure out. And the way I've kind of the way I've come to think about the way I've come to think about countries holding treasuries is the way that a retail person like you or I might hold a CD, where you can't necessarily spend a CD just like a country can't necessarily spend a treasury if they want to shore up their currency or do something else with it. They need to turn the US treasury into US dollars, so UST into USD. And the problem that I think that goes on is that when they have to, nobody wants to sell at a discount. And the only reason somebody theoretically would sell at a discount if they don't want to is because they must sell at a discount. This goes into your prior point about China having to sell out of weakness, then being in a position of strength. It's also interesting that you mentioned the BRICS too. Earlier this year, what was it, late August, it seemed like there was a golden opportunity, no pun intended, for the BRICS to actually offer some sort of alternative, or at least have a public acknowledgement that the process was going to start, but it missed. Or at least to the best of my knowledge, it missed. I don't know what went on behind the scenes, but at least publicly, nothing's there yet. So I think what's interesting too is when it comes to China, there's the charts have been floating around FinTwit the past few days showing, the ones with the graph going down in terms of the reserves in dollars that China's holding. And one of the things I'm still trying to get an answer and an understanding to is this just the notional value of the treasuries that they're holding, or is this actually a decrease in the amount of treasuries that they're holding, setting aside any treasuries that are naturally maturing or just rolling off the books through, normal business activity?
So if China is actually selling these treasuries to get dollar liquidity because they can't get it in the repo market or other forms of lending, that is a huge problem. And there's no real way to tell which one is which if they're doing it as an act of strength or weakness. But if it is the act of weakness, this shows huge global issues to pretty much the entire world. Because just think about it, China is one of the biggest trading partners in the world. And if no other countries are willing to lend to China in dollars, which is the usual form of measurement that they are transacting in, then they are just honestly being kind of shut out by the euro dollar market, which would pose catastrophic consequences for China, and I think more importantly, what could potentially happen in the rest of the world.
Yeah. One of the interesting things that I was thinking about the other day is one of the, obviously like really following Brent Johnson and John, I can't say his last name, Kuzmita, with the Milkshakes, Markets, and Madness podcast. So good. But another person I would like to follow too, even though I cautiously disagree from his views from time to time, is Alistair McLeod, who's a relatively notable commentator in the gold space. And McLeod made the comment that so this is me trying to channel it both Johnson and McLeod at the same time, which is interesting because they're not necessarily on the same page, or at least not necessarily aligned the same philosophically. It gets back to the idea of collateral. And this is where Snyder would come back in too. And the point is that if U.S. Treasuries are the linchpin that are underlying collateral, and if treasuries are becoming impaired, or at least have become impaired on a mark-to-market basis, then this is McLeod talking right now, then it's quite possible that the people who have pledged treasuries as collateral for whatever exotic transactions they've engaged in need to shore up the collateral. They either need to deposit more of it or provide cash. This gets back to the China thing, or let's just say any large player, a sovereign, a large financial institution, whatever. If they're having to go into the market and liquidate UST for USD in an environment where rates are materially higher than when they bought the initial treasury, they're taking a haircut. And presumably, if a sovereign, or let's just say a large entity, is going in and having to sell a material amount of treasuries, even though it's not maybe their entire portfolio, they're selling into a weak environment, which is only going to send the price down, or it would only spike yields further, sending the price down of the treasuries, which means that anyone who's sitting on the margin might be sucked in. And so I don't want to say that you're about to hit the vortex, but I just simply note that the dynamics seem to be setting itself up for that.
Yeah, I think we're actually quite a ways off, but it is very important to look at this. And why do I think that? So, the first form of lending, and we saw this in 2020 and 2008, is people need dollars. So, they usually are going to sell the more illiquid forms of their assets that they have, or the less liquid. And the most liquid is short term T bills. The least liquid on the to get dollars would be the long dated treasuries, which we see that they're selling. And it would be mortgage backed securities and other securities like that. So we can see they're selling off the long end, which is usually what these counterparts do. But what we have not yet seen is we have not seen T-bills start to spike in price and go down in yield. And that is probably the most important tell. If shit's really going to hit the fan, if we see 10, 15 basis point moves in the 1 month T-bill coming up, then people are really trying to get as much liquidity as humanly possible, because that's what they can use to go into the repo market and get more dollars, and that's kind of how they can manipulate their balance sheet to the highest degree. Just with dollars, I don't exactly know. They could be going into the repo market and getting those T-bills still, but we don't see them buying the T-bills outright. And I think that's a pretty big sign that shit is not completely hitting the fan. This isn't Armageddon, but I do think it's very important to look at where the trends are going. And this might take 5, 6, maybe 12 months to play out, because this is a very slow process. And everyone makes videos saying that everything's going to hit the fan today, but that is just never how anything happens.
Yeah.
Everything is a slow process, but you have to see on the horizon. And on the horizon, people are now looking like they need dollar liquidity, and the DXY is starting to spike up. That is horrible for the rest of the world, because if people have that dollar denominated debt, let's say China and Evergrande and all these companies that are starting to hit the fan, if their debt is dollar denominated and the dollar is now going up, but their income is in yen, now they have to get more money just to pay off their debt. That is not a good business model right there, and that's what we're seeing. So
Yeah.
this is something to be pretty concerned about.
Yeah, and this is also where you tie back in, the dollar milkshake theory, because if a foreign central is going to try to shore up their own internal companies by printing their own internal fiat, just exchange back into dollars because they're having problems making the dollar denominated debt, that is not going to make the problem better in the long run. And at the same time, too, it gets back to the other thing, too. It's like, if you need cash and you're having to liquidate CDs early, you can do it. You're just going to do it at a penalty. And right now, just curiosity, like if you had bought like a 30-year, let's say like 5 years ago at, let's say, not the trough, but like a relatively low point, and you're having to sell, let's say, 25 years before maturity, what type of haircut are you taking? Is that like a 30% haircut right now? What I'm trying to make is that it's really quite like a damned if you do and damned if you don't, which I know is said all the time here, where you have, if you had a foreign sovereign who who needed to send the dollar down or to make their currency appreciate against the dollar, and at the same time, one of the only tools they had to do that was the liquidation and selling of their USTs early, or their foreign reserves USTs early. And at the same time, if interest rates are high, my God, just look at all those headwinds they're having to sell into.
Well, they're not really taking too much of a loss. It's more so they're liquidating a yield that they would have otherwise got. And I mean,
Yeah.
if they bought in 2020 and they're liquidating now, that is a huge loss. But anywhere for the pretty much the past 30 years, you'd be fine, unless, well, actually, not really. You're still taking a loss pretty much any time within the past 20 years. So pretty much, if you bought a 30-year treasury in the past 20 years and you are selling it now, you are most likely selling it at a loss. And who would do that? Honestly,
Yeah.
the
Well,
only
someone who
way-
has to. That's
think about SVP. That is exactly what happened to Silicon Valley Bank. They bought those treasuries and they were just going to hold them to maturity. But what happens when shit's hitting the fan? You're saying, "Oh my God, I have to liquidate these for the dollar so I can pay back my investors." That is not good. So therefore, they're taking a loss just to refund their customers. And that's exactly what the rest of the world is doing. If you think that's a problem for Silicon Valley Bank, what if the entire global monetary system and all these big corporations are doing that just to get the dollar liquidity so they can pay off their debt? You could really see some bad stuff going on. But
Yeah.
again, I don't think it's happening right now, because I think the real telltale sign when stuff's really starting to get bad is going to be the short-term T-bills, when people are buying as much of those as they possibly can, because that's when they're grabbing onto the most liquid asset as humanly possible.
Yeah. Another thing, and I don't even know the metric or where would even begin to look at it. But I suspect another factor here is velocity, because if you have liquidity going down, but the velocity of the remaining liquidity is increasing, you might be able to still, I don't even know the term.
Well, that would
for
be
it.
the collateral multiplier effect. And I would
Okay.
argue that that's most likely going down. There was a video where Jeff Snyder was talking about, let's say you are a Japanese bank, or you're seeing liquidity in Japan really start to slow down. And he thinks the reason for that is because everyone knows Japan's main counterpart is China. So if they know, let's say you're a European bank and Japan needs a short-term loan, they're not giving Japan that loan because they know that Japan is going to go give that loan to China, and they don't trust the China part. So that there's a multi-leg issue going
Yeah.
on here where China doesn't trust Japan because they think they're going to work with China. And if China is so bad, they don't think China's going to be able to pay back Japan. That means Japan wouldn't be able to pay back Europe. And that, I mean,
Yeah.
that is how global liquidity starts to slow down really, really quickly. And we seem to be at the tail beginning of it.
Yeah. It's like trying to fly an airplane when you need, like, the rudder, the tail, the wings, all the other stuff, and all that you can control is the engines. Good luck. I'm not saying you can't do it for a little bit, but good luck. So.
All right, we're back. Maybe. I don't know. We might start videos again. Hopefully. We'll see what happens.